At first glance, the housing market looks normal. Homes are still listed, prices are still posted, agents still talk about demand, and headlines haven't turned red yet. Nothing appears broken. And that's exactly what makes this moment so uncomfortable. Because when you look a little longer, something feels off. Homes sit just a bit longer. Buyers visit, ask questions, then disappear. Sellers wait, confident that time is on their side, while momentum quietly slips away. This is the phase most people don't recognize. Not a crash, not a boom, just a strange stillness. A market that hasn't fallen, but has stopped moving. Decisions slow. Confidence softens. Activity looks present, but commitment is missing. It's subtle enough to ignore, especially if you're trained to watch prices instead of behavior. Here's the part that matters, and the part few people understand. Housing markets don't break when prices drop. Prices drop after something more important has already changed. Before headlines shift, before panic sets in, before numbers turn obvious, the market does something quieter. It freezes. And if you know what you're looking at, this stage tells you more than any price chart ever will. Most people realize it after the window closes. A housing freeze is often misunderstood because it doesn't look dramatic. There are still homes on the market, prices are still visible, listings refresh daily, and nothing appears to have collapsed. But beneath that surface, something essential has changed. The market hasn't stopped existing, it has stopped deciding. Buyers pause longer, sellers wait instead of adjusting. Activity continues, but momentum quietly drains away. This is where many people get misled. They're trained to watch prices, so as long as prices haven't fallen, they assume the market is healthy. But price movement and market movement are not the same thing. Price is a result. Movement is a process. One lags, the other leads. When a market freezes, it's not because prices are wrong, it's because people no longer trust the conditions that would make a decision feel safe. In a freeze, liquidity is what disappears first. Liquidity isn't about whether a home exists or what it's listed for. It's about how easily someone can act. Can a buyer move forward without fear of regret? Can a seller adjust without feeling like they're giving something away? When liquidity dries up, hesitation replaces urgency. Homes still show, conversations still happen, but offers thin out, timelines stretch, and every step forward feels heavier than it should. This creates a strange illusion. From the outside, the market looks intact. From the inside, it feels stuck. Buyers sense risk, even if they can't articulate it. Sellers feel confident but uneasy. Both sides are waiting for the other to move first. And while everyone waits, the market loses its ability to clear efficiently. This is why price stability can be misleading. Prices often stay flat precisely because nothing is moving. Sellers resist lowering because there's no pressure yet. Buyers resist offering because they're unsure what comes next. The standoff creates stillness, not balance. And that stillness is the signal. Long before prices adjust, behavior has already changed. If you learn to watch movement instead of numbers, you stop reacting late and start understanding early. This phase is uncomfortable because it challenges identity. Buyers who see themselves as decisive start doubting their instincts. Sellers who believe they understand their market suddenly feel less certain. Professionals talk more, but act less. Everyone senses that acting too early could be a mistake, yet waiting feels safer. That tension is not random. It's the market communicating through behavior instead of headlines. Once you understand that, the freeze stops feeling mysterious. It becomes readable. And when a market becomes readable, it stops surprising the people who know how to listen. That awareness quietly separates observers from participants and preparation from reaction long before charts, forecasts, or headlines catch up to the reality. The earliest signs of a housing freeze rarely look dramatic. They look like hesitation. Buyers get approved, their numbers work on paper, and yet something holds them back. They tour homes, ask the right questions, imagine their furniture in the rooms, then say they want to think about it. Not because they can't buy, but because they're unsure whether buying right now is the right move. That pause is not weakness, it's information. You see it again when showings don't convert. Foot traffic exists, open houses aren't empty, but offers don't follow. Weeks pass where interest feels real, yet commitment never arrives. To someone watching casually, this looks like normal variability. To someone paying attention, it's a pattern. The market isn't rejecting homes outright. It's hesitating, collectively, as if waiting for permission to move. Then there's the way listings start to linger. Not dramatically longer, just slightly past what used to feel normal. 10 days becomes 20, 20 becomes 30. Nothing alarming enough to trigger panic, but enough to create quiet discomfort. Sellers notice it first. Agents feel it in their conversations. The home isn't failing. Time is simply stretching, and stretching always has a reason. Deals falling apart late are another signal people explain away. Inspections uncover small issues that suddenly feel bigger than they used to. Financing hiccups become deal breakers. Buyers walk away days before closing, not because something catastrophic happened, but because the margin for uncertainty feels thinner. When confidence is high, problems get solved. When confidence fades, the same problems end decisions. Quiet price adjustments often follow, and they're easy to miss. A few thousand shaved off. A credit offered instead of a cut. Incentives framed as generosity rather than necessity. These aren't desperate moves. They're experiments. Sellers testing whether a small concession can restart momentum without admitting the market has shifted. Sometimes it works briefly. Often, it doesn't. What ties all of this together is choice. None of these behaviors come from failure or fear alone. They come from people sensing risk before it becomes obvious. Buyers hesitate not because they're broke, but because they're unsure. Sellers adjust not because they're panicking, but because they're probing for certainty. Everyone is acting, just more carefully. Once you recognize these signals, they're hard to unsee. You start noticing how often "we'll wait and see" replaces urgency. How conversations grow longer while decisions grow shorter. How confidence turns conditional. This isn't imagination. It's a market communicating through behavior instead of numbers. And here's the uncomfortable truth. Most people don't miss these signs because they're unintelligent. They miss them because they're trained to ignore them. We're taught to wait for confirmation, for prices to move, for headlines to change. But by the time that happens, the important choices have already been made, one hesitation at a time. Understanding this shifts your identity. You stop seeing the market as something that suddenly changes and start seeing it as something that slowly reveals itself. You move from reacting late to observing early. That doesn't mean predicting outcomes. It means recognizing moments. And moments like these matter, because they decide who feels rushed later and who feels prepared. The difference isn't access to secret data. It's the willingness to notice what others dismiss as noise when everything looks fine on the surface. Buyers don't pull back because they suddenly stop wanting homes. They pull back because the ground beneath the decision starts to feel unstable. At first, it's subtle. A sense that committing right now carries more weight than it used to. Buying a home is already one of the largest financial choices a person makes, and when uncertainty rises, that weight multiplies. The fear isn't about price alone. It's about locking in a decision that can't easily be undone. Rate volatility plays a quiet but powerful role here. When rates move unpredictably, buyers stop trusting the math. Monthly payments feel temporary instead of fixed. A number that works today might not feel reasonable tomorrow. Even qualified buyers hesitate, not because they can't afford the home, but because they can't anchor their confidence to stable terms. When the rules keep shifting, waiting feels safer than acting. Then come the costs no one fully controls. Insurance premiums change. Property taxes reassess. HOA fees rise with little warning. Each variable adds another unknown to the decision. Individually, these costs might seem manageable. Together, they create fog. Buyers start asking not just, "Can I afford this?" but "What might this turn into?" And when the future feels unclear, restraint becomes a form of self-protection. Conflicting narratives make this worse. One voice says, "Buy now or be priced out forever." Another warns of overpaying at the peak. Headlines swing between optimism and caution, often in the same week. Friends, agents, and online commentators all offer certainty, yet none agree. Faced with too many confident answers, buyers lose trust in all of them. Decision paralysis sets in, not from ignorance, but from overload. This is where loss aversion quietly takes over. The fear of making the wrong move becomes stronger than the desire to make the right one. Buyers imagine regret more vividly than opportunity. Overpaying feels permanent. Waiting feels reversible. Even if waiting carries its own risks, it doesn't feel like a mistake yet. So, hesitation wins. What's important to understand is that buyers aren't waiting for discounts. They're waiting for clarity. They want stable rules, predictable costs, and a narrative that makes sense. When clarity disappears, demand doesn't vanish, it retreats. The desire to own remains. The willingness to commit does not. This shift changes identity. Buyers stop seeing themselves as decisive actors and start seeing themselves as cautious observers. That's not weakness, it's adaptation. Under pressure, smart people pause. And when enough people pause at the same time, markets don't fall immediately. They stall. Understanding this reframes buyer hesitation not as fear, but as intelligence responding to uncertainty. That perspective doesn't tell you what will happen next. It tells you why the market moves the way it does long before prices ever respond. This is why moments like this feel emotionally heavy for buyers. They're not stepping back because they lack confidence in themselves, but because they sense the environment asking for patience. In calmer markets, speed feels rewarded. In uncertain ones, restraint feels wiser. Recognizing that difference is empowering. It allows buyers to trust their instincts without shame, to understand that waiting is sometimes a strategic choice rather than a missed opportunity, and to see hesitation as a signal worth respecting, not something to rush past under pressure. That awareness quietly changes everything. Sellers experience a freeze very differently from buyers. Where buyers hesitate quietly, sellers hold on. Most sellers anchor to a version of the market that feels recent and familiar, the peak that still lives clearly in their mind. That number becomes more than a price. It becomes a reference point for fairness, success, and identity. Letting go of it feels less like a market adjustment and more like admitting loss, even when nothing has technically gone wrong. So instead of adjusting, many sellers wait. They tell themselves the market just needs time. A few more weeks, a better season, a different headline. Waiting feels responsible because it avoids regret. But waiting is not neutral. While a seller waits, the market keeps moving underneath them, even if prices haven't. Momentum fades, attention shifts, new listings quietly reset buyer expectations. When waiting doesn't bring relief, some sellers pull their listings entirely. They step back, convinced the problem is timing, not pricing. Others decide to rent temporarily, framing it as a strategic pause rather than a retreat. On paper, these choices feel flexible. In practice, they often lock sellers into paths that are harder to exit later. Temporary becomes longer than expected. Carrying costs accumulate. Optionality shrinks. Then there are cosmetic adjustments. Small price trims that signal cooperation without conceding reality. Credits instead of cuts. Incentives instead of recalibration. These moves are attempts to preserve dignity while testing demand. Sometimes they buy time. Rarely do they restore momentum. Buyers sense hesitation instantly. A market already unsure doesn't respond well to half measures. What most sellers underestimate is time itself. Time isn't just days on market, it's energy, it's attention, it's positioning. Each additional week conditions buyers to expect more flexibility later. Each delayed decision compounds pressure quietly, invisibly. Sellers think they're holding steady, but the market is recalibrating around them. None of this comes from stubbornness or ignorance. It comes from being human. Sellers are reacting to uncertainty the same way buyers are, by trying to protect themselves. The difference is that sellers pay for protection in time, not fear. And time is expensive when liquidity is already thinning. This is where inevitability enters the picture. In a freeze, small delays don't reset the market, they deepen it. The longer movement stays stalled, the harder it becomes to restart cleanly. Not because sellers did anything wrong, but because markets remember hesitation. Understanding this doesn't mean rushing decisions. It means respecting the cost of waiting. Sellers who recognize this early retain choice. Those who don't often discover it later, when the options feel fewer and the adjustments feel heavier than they needed to be. This moment quietly tests a seller's identity. Are they someone protecting a number or someone managing a process? The market rewards the second long before it rewards the first. Sellers who adapt early aren't giving in. They're staying aligned with reality as it changes. That alignment creates leverage. It keeps choices open. It reduces the emotional tax that builds when decisions are postponed too long. In every cycle, the sellers who emerge strongest aren't the ones who waited for certainty, but the ones who understood that clarity rarely arrives before movement. They acted when it felt uncomfortable, not when it felt obvious. And that difference is what separates control from reaction. Prices are always the last thing to move, and that confuses people because price is what we're taught to watch. Charts, headlines, comps, averages. It feels objective, concrete, safe. But price is not a leading voice in housing, it's an echo. By the time prices change, decisions have already been made quietly over months through behavior most people ignored. One reason is comps. Comparable sales look backward by design. They're built on what closed yesterday, not what hesitated today. When deals slow, comps don't immediately show it. They preserve the past longer than the present deserves. Appraisals follow the same logic. They anchor value to confirmed transactions, not fragile intent. So even as movement weakens, prices appear stable because the system hasn't caught up yet. Seller psychology reinforces this delay. Sellers don't experience the market as data. They experience it as memory. The last strong offer, the neighbor's sale, the peak they mentally claimed as fair. Price becomes identity. Adjusting it feels personal, not procedural. So sellers resist change until resistance itself becomes more uncomfortable than adjustment. Institutions add another layer of inertia. Lenders, underwriters, and large market participants rely on slow confirmation. They move cautiously, not emotionally. Their systems are designed to reduce risk, which also slows response. When behavior shifts, institutions don't react immediately. They wait for proof, and proof requires time. Media narratives stretch that timeline even further. Stories favor certainty over nuance. Stability sells better than transition. A market that's freezing doesn't fit neatly into a headline, so it gets framed as resilient, balanced, or strong. That framing reassures the public while obscuring the quiet change underneath. This is where perspective flips. Most people think prices cause behavior. In reality, behavior causes prices. Buyers hesitate. Sellers wait, liquidity thins, and only then do numbers adjust. Price drops don't initiate downturns. They confirm that the decision to slow down already happened. Understanding this changes how you read the market. You stop waiting for permission from charts. You start paying attention to movement, confidence, and ease. Prices will always follow, but they never lead. They arrive last, carrying news that was already old to anyone watching closely. That calm certainty is what separates reaction from understanding, and late realization from quiet preparation. This is why people feel blindsided when prices finally move. They believe something sudden occurred, when in truth the shift unfolded slowly in plain sight. By the time prices react, flexibility is already reduced. Options narrow. Urgency replaces patience. Those who waited for numerical confirmation feel rushed, while those who watched behavior feel steady. This isn't about predicting outcomes or timing, bottoms. It's about orientation. Knowing which signals speak first allows you to stay grounded when noise rises. You don't need to be early to everything. You only need to avoid being last. Recognizing that prices are followers, not leaders, gives you a calmer relationship with uncertainty and a clearer sense of when to act. That perspective quietly builds confidence when others search for reassurance elsewhere. This phase doesn't announce itself with certainty, and that's precisely its purpose. A freeze creates space. Not clarity, not answers, but room for reality to rearrange quietly. It allows pressure to dissipate without forcing resolution. Markets use this time to test conviction, to see who truly needs to act and who simply wanted reassurance. Nothing dramatic has to happen for meaningful change to occur. During this period, flexibility becomes unevenly distributed. Those who aren't overextended gain breathing room. They can wait, observe, renegotiate, or simply choose not to participate. Optionality stays intact. Others, tied to timelines, leverage, or emotional attachment, slowly lose that freedom. Each passing month narrows their range of choices, not because prices moved, but because circumstances did. The freeze doesn't punish immediately. It differentiates gradually. This is why patience matters more than timing. Timing assumes a moment you can identify and capture. Patience is a posture you can hold. It means staying responsive instead of reactive, present instead of predictive. People who confuse patience with inaction miss the point. Patience is active awareness without forced decisions. It's the discipline to let information accumulate before committing identity and resources. What's dangerous isn't waiting. It's waiting blindly. A freeze rewards those who pay attention to behavior, to tone shifts, to effort levels, to how hard or easy movement feels. It penalizes those waiting for certainty that never arrives. By the time certainty shows up, flexibility is often gone. This phase isn't a warning or a promise. It's an invitation to notice how you relate to uncertainty. Do you feel pressure to act because others expect it, or because conditions truly align? Do you seek reassurance from numbers or understanding from patterns? Markets don't ask these questions out loud, but they do ask them consistently. There's no final takeaway here, no prediction to lean on. Just an awareness that moments like this shape outcomes quietly. Long before results are visible, choices are already being sorted. The only question worth sitting with is whether you're moving from urgency or from clarity that hasn't fully formed yet. That distinction matters right now.